The world economy stands at a precarious juncture. Forecasts for 2025 and 2026 paint a picture of slowing growth. This is not a sudden storm but a culmination of pressures building for some time. Global GDP growth is decelerating, with the OECD projecting a decline from 3.2% in 2024 to 3.0% by 2026. This trend signals a period of economic cooling that could affect jobs, businesses, and household incomes worldwide. Persistent inflation remains a major concern, eroding the purchasing power of consumers. Central banks have responded by raising interest rates to cool down demand and bring inflation under control. However, these higher interest rates also make borrowing more expensive, dampening investment and spending. Global public debt has reached unprecedented levels, creating vulnerabilities for many nations. Different regions and countries will experience varying degrees of economic pressure. Emerging markets could face significant headwinds, while advanced economies grapple with challenges like energy price volatility and demographic shifts. The interconnectedness of the global economy means that a slowdown in one major region can have ripple effects worldwide. Historically, periods of high inflation followed by aggressive monetary tightening have often preceded economic downturns. The current environment is further complicated by geopolitical tensions and ongoing disruptions to global supply chains. The challenge now is to manage these risks effectively and steer the global economy towards a softer landing. This requires astute policy choices and international cooperation. Understanding these dynamics is crucial for policymakers and businesses as they prepare for the uncertain times ahead. Inflation has proven to be a stubborn adversary in the post-pandemic era. While global headline inflation has shown some signs of easing, it remains elevated in many parts of the world. Core inflation is expected to stay above central bank targets in numerous G20 economies through 2026. This persistence means that the cost of living crisis continues for many households, directly impacting consumer spending. Supply chain disruptions, increased energy and commodity prices, and strong demand in certain sectors have all contributed to persistent inflation. Food inflation, averaging above 6% globally, disproportionately affects lower-income households. Central banks are forced to maintain a hawkish stance, even if it means risking slower economic activity. The longer inflation remains elevated, the greater the risk of it becoming entrenched in expectations, potentially creating a wage price spiral. Central banks are acutely aware of this danger and their commitment to price stability is being tested. The path ahead requires them to navigate the risks of doing too little to fight inflation versus doing too much and triggering a deep recession. Each nation faces its own unique battle against rising prices. In response to persistent inflation, central banks across the globe have raised interest rates. The U.S. Federal Reserve, for example, maintained its policy rate in a restrictive range of 4.25% to 4.50% in early 2025. The objective is to make borrowing more expensive, cooling down demand for goods and services. However, this medicine comes with significant side effects for economic activity. Higher interest rates increase costs for businesses seeking loans, leading to a slowdown in investment, innovation, and job creation. For consumers, mortgages, car loans, and credit card debt become more burdensome, reducing disposable income and curtailing spending. The housing market is often one of the first sectors to feel the pinch. The European Central Bank and the Bank of England are also navigating this complex environment with varying approaches. The full impact of these interest rate hikes is often felt with a delay, making it difficult for central bankers to fine-tune their policies perfectly. There is a constant risk of either not tightening enough to quell inflation, or tightening too much and pushing the economy into a recession. As we move through 2025 and into 2026, the cumulative effect of past rate hikes will continue to weigh on global growth. The hope is that inflation will recede sufficiently to allow for a gradual loosening of monetary policy before a severe downturn takes hold. Beyond inflation and interest rates, another ominous cloud hangs over the global economy, a mountain of debt. Total global debt surpassed $324 trillion in the first quarter of 2025. This figure includes government debt, corporate debt, and household debt. The global debt-to-GDP ratio remains stubbornly above 325%. Such high levels of indebtedness create significant vulnerabilities, limiting the capacity of governments to respond to future crises. Public debt is a particular area of concern, with global public debt set to climb by another 2.8% of global GDP in 2025. This surge in public debt is a legacy of various factors, including responses to the 2008 financial crisis, the COVID-19 pandemic spending, and ongoing fiscal deficits. Persistently high debt levels can become unsustainable, especially in an environment of rising interest rates. Emerging markets are facing an especially acute debt challenge, with a collective debt-to-GDP ratio reaching a record high of 245%. These countries often have less fiscal space and are more vulnerable to changes in global investor sentiment. A strengthening US dollar can make it much more expensive for emerging markets to repay dollar-denominated debt, leading to debt distress and, in worst-case scenarios, sovereign defaults. Such events can have contagious effects, spreading financial turmoil to other countries and further dampening global economic prospects. The problem with high debt is that it reduces resilience, making it harder for heavily indebted governments to borrow easily or cheaply to cushion the blow of new economic shocks. This can lead to more painful adjustments such as deep spending cuts or sharp tax increases, worsening an economic slowdown. High debt can also crowd out private investment as governments compete for limited savings. Addressing the global debt overhang will require a combination of fiscal consolidation, structural reforms to boost growth, and in some cases, debt restructuring. This is a long-term challenge with no easy solutions. The anticipated global economic slowdown will not affect all regions equally. Major economies are bracing for different levels of impact, reflecting their unique domestic conditions, policy responses, and exposure to global headwinds. The United States is projected to see its growth decelerate significantly, with the OECD forecasting a decline from 2.6% in 2024 to 1.6% in 2026. The euro area is also facing a period of subdued economic activity, with modest growth projected at 1% in 2025. Countries within the eurozone will likely experience varied outcomes depending on their industrial structure, energy dependence, and fiscal health. In Asia, China's growth is moderating, with the OECD projecting growth at 4.7% in 2025. India is also expected to see its growth revised downward, with the UN projecting 6.3% in 2025. The performance of these large Asian economies will significantly influence the overall global outlook. Other regions are also facing downward revisions, with Canada's growth outlook revised down to 1.4% and Mexico facing a potential contraction of 0.3%. These figures underscore the widespread nature of the anticipated slowdown. While some economies might avoid an outright recession, the general trend is towards weaker growth. This uneven landscape complicates global policy coordination. It also highlights the importance of region-specific strategies to mitigate the negative impacts and foster resilience in the face of economic headwinds. The interconnectedness of the global economy means that a slowdown in one major region can have ripple effects worldwide. Understanding these dynamics is crucial for policymakers and businesses as they prepare for the uncertain times ahead. Global trade, a traditional engine of economic prosperity, is facing significant headwinds. Projections for trade growth in 2025 are notably pessimistic, with the IMF expecting global trade growth to dip to a mere 1.7%. This slowdown in international commerce is a symptom of deeper issues including rising protectionism, ongoing supply chain disruptions, and increased geopolitical fragmentation. The imposition of tariffs and other trade restrictions has disrupted supply chains, increased costs for businesses and consumers, and dampened investment. For example, the United States announced new tariffs on goods from Canada, China, and Mexico, increasing the global effective tariff rate. Geopolitical fragmentation is further straining the multilateral trading system, marginalizing smaller economies that rely heavily on open and predictable international markets. The stability of the global trading order underpinned by institutions like the World Trade Organization is being eroded. This makes it harder to resolve disputes and enforce common rules, resulting in a less efficient and more volatile global marketplace. The impact of these trade tensions extends beyond mere economic statistics, as tariffs can act as a negative supply shock, reducing productivity and output. They can also decrease competition and stifle innovation over the long term. Businesses may become hesitant to invest in new markets or technologies if they fear sudden policy changes. Restoring stability to trade policy and forging new cooperative trade agreements are crucial steps to counter these negative trends. These actions are needed to revive global trade as a positive force for economic growth and development. The interconnectedness of the global economy means that a slowdown in one major region can have ripple effects worldwide. Understanding these dynamics is crucial for policymakers and businesses as they prepare for the uncertain times ahead. Navigating the anticipated global economic slowdown requires a multifaceted policy response. Central banks face a difficult balancing act, addressing inflation without tipping economies into deep recessions. This may involve carefully calibrated interest rate adjustments and clear communication about future policy intentions. On the fiscal front, governments need to be cautious, focusing on targeted support for the most vulnerable households and businesses. Fiscal policy should prioritize investments that enhance long-term growth potential, such as in green energy, infrastructure, and education. Structural reforms aimed at boosting productivity, improving labor market flexibility, and fostering competition can also play a vital role. International cooperation is more important than ever, with countries working together to restore stability in global trade and address global challenges like climate change and pandemic preparedness. Mechanisms for orderly debt restructuring for countries facing distress need to be strengthened to prevent financial crises from spreading. Looking ahead, the path for the global economy in 2025 to 2026 is uncertain, with risks tilted to the downside. The effectiveness of policy responses will be critical in determining the depth and duration of the slowdown. Individuals and businesses should stay informed about economic developments and prepare for potential volatility. This might involve building financial buffers, diversifying investments, and adapting business strategies. Fostering resilience at all levels, individual, corporate, national, and international, will be key to weathering the storm and laying the groundwork for a sustainable recovery. The interconnectedness of the global economy means that a slowdown in one major region can have ripple effects worldwide. Understanding these dynamics is crucial for policymakers and businesses as they prepare for the uncertain times ahead. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.